So, welcome to today's presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals. Now, it's been actually an interesting morning, especially about the Asian session. There was a mess up in the markets. And on a fundamental level, we highlight that Monday's opening actually began on Friday's rather late American session. We had Fed Chairman Powell speaking on Friday afternoon in the American session, which practically, now the Fed chairman on the one hand practically realized, or if you prefer, acknowledged that monetary policy is already at very restrictive levels. And that was a hint that no more rate hikes are coming, that the Fed's done. On the other hand, though, he tended to warn the markets that it's premature to start talking about a possible rate cut. But it seems as if the market neglected the second part. And practically right now, the market is pricing in 5 rate cuts, all being of 25 basis points each. And that's going to be happening, or the market expects it to be happening in 2024. That should reduce practically the interest rates to 4.25% by the end of next year. May I also add here that there are a number of analysts which are highlighting the possibility of not 5 rate cuts, but 6 until the year's end next year. Overall, that tended to intensify the bearish sentiment of the market for the US dollar. However, that was not so visible as such, despite some drop of the USD against its counterparts on Friday. I would note, or if you prefer, would highlight that gold benefited the most. And allow me to start today's presentation with gold's chart. Now let's have a look. This is gold's 4-hour chart. Let's make a small correction here. Now definitely we can see how the price action, if we drill to the daily chart, it becomes even more obvious. Note how, zooming in, note how gold's price was on the rise. This is on Friday. And note what happened during today's Asian session. It was a huge rally, which practically brought gold's price above $2,130. It's a record high level. Okay, understandably, gold's price corrected lower within the Asian session. It would be interesting to drill into the 1-hour chart here. And you can see the spike at the opening and the correction lower later on. So more or less, I would be noting that there were some bullish tendencies, yet in the 1-hour chart, we see the RSI indicator, which has reached the reading of 50 and stabilized, implying that the precious metals price may stabilize somewhat. Back to the daily chart. Let's have a look at the big picture here. There's a clear upward movement. Like this. So despite the correction lower, we tend to maintain our bias for an upward movement. In the daily chart, note that the RSI indicator is above the reading of 70, which more or less highlights the bullish tendencies within the market sentiment. On the other hand, though, maybe also implying that the precious metal is at overbought levels and is ripe for correction lower. That's a signal which is being sent also by the fact that the price action has breached the upper Bollinger Band. Note how the Bollinger Bands have widened. That was beyond expectations. Okay, there were some bullish expectations, but nothing like this. Let's see how high it can go. Now, definitely, we're going to be setting a resistance line here, which is a peak of Friday. And the next one's going to be up here. Now we have to drill into the 1-hour chart maybe even lower. Yeah, allow me to go even to the 15 minutes and see how the market priced in the correction lower. 30 minutes, 1 hour. That's better. And I'm setting a new resistance line here on this peak here. Okay, let's add some back to the 4-hour chart. Let's place some labels. Definitely we have to reverse the colors. And at this point, I would be noting also the possibility of a correction lower. So I'm going to be lowering the S3 far, far lower. Excuse me. Starting with the first resistance line, which is being set at 2075. Coloring this in red. Let's add also label. The second resistance line being set at 2100. And the third resistance line towards the tip of the iceberg, 2136. In red, please. The move practically took traders by surprise. And I would be highlighting here that a number of traders lost considerable amount of money, especially shortening the precious metals price. As there were lots of traders which had highlighted the possibility of the precious metals price actually correcting lower. That did not happen. And if you were short, I hope that you had your stop losses on. (2022), the second one in green. And the last one, (1988). Okay. So for the time being, actually, I'm still bullish on gold. I expect that there would be a wider correction. That's understandable. But I would expect the bullishness of gold to be maintained. It's interesting what the members of the research team have mentioned would be this, that there is another trend line which seems to be followed. And this kind of steeper than the previous one. That's something which remains to be seen. Allow me to drill into the daily chart, narrow it a little bit here. Back to the 4-hour chart. Here you go. So you have a beginning point at the 13th of November going up, one checkpoint around the 20th of November, another checkpoint on the 23rd, 24th of November. However, at this point, we have to note that the upward trend line starts to steepen to the upside. You can see how this is practically being played out. So I would expect the first upward trend line to be this one. The second here. Once again, the bullish tendencies remain there. Yet I would be highlighting at this point that in the 4-hour chart, the RSI indicator has dropped below the reading of 50, implying that the bullish sentiment for the precious metal is slowly fading away. That's understandable given the correction lower. Should the bulls regain control, I would expect the price action to bounce on the upward trend line, breach the R1 2075, and start aiming for the 2100 once again. There is a very, very high probability that this peak will not be reached, at least not in the next 24 hours, or it's going to be very difficult to be reached. I would be surprised to see that. On the other hand, should there be a stabilization, which is quite possible, then I would expect the price action to remain in a sideways motion between the R1 and the 2075 and the S1, the 2048. While a bearish outlook could occur should the price action continue to drop, breach the first upward trend line, breach the 2048 support line, breach the second upward trend line, and at least touch the 2022 support level. That would allow us also to start drawing a nice downward trend line, showing us the limitations of the downward movement. It's a very, very interesting chart, and it's very exciting in the sense of what's going to be happening. I would be noting here that you can see small rising star here. Allow me to zoom in a little bit further. This one. This candlestick here actually was a bullish signal, and it tended to warn us in the 4-hour chart of what's going to be happening. If we drill into the daily chart though, ladies and gents, a shooting star. However, that's still in the making. It hasn't closed just yet. Or if you prefer, an inverse hammer. Now, should that be the case, that would imply, in my opinion, that practically the price action, the bulls have gone as far as they could and corrected lower. And that would be a signal for reversal, which could lead the price action of gold far, far lower. Back to the 4-hour chart. Okay, let's have a look now at Euro USD going to FX pairs. Actually, you know what? I would be more interested to have a look at the Aussie. And the main reason I'm mentioning the Aussie here is because RBA is going to be having an interest rate decision tomorrow during the Asian session. Let's correct the labels here. And definitely we have to make a correction on the resistance and support lines. Now, about RBA, the bank is widely expected to remain on hold at 4.35%. That's not the issue here. The big issue is whether RBA Governor Michelle Bullock will be actually signaling, or if you prefer, maintaining a hawkish or a dovish tone. As practically, I think that's going to be the main interest of the market, in the sense that will RBA start signaling that it's about to U-turn and start cutting rates or not? Now, should RBA's governor actually signal such a scenario, that may more or less weigh on the Aussie. And allow for a more bearish outlook to emerge. Let's go back now, hunting for a new resistance line. This beautiful peak here. And it was aimed for here as well, once, twice. I'm keeping that. Okay, it could go a little bit higher. No, I'm keeping that level. Readjusting, zooming in. In red, that would be the 0.69 resistance level. Okay, let's correct the labels. Starting with the S3, which is being placed now at 0.64. The S2 at 0.6515. The S1 at 0.6605. The R1 at 0.6725, that's a bit wide. The R2 at 0.6820. And finally the R3 at 0.69. Locking it in. You can see how the price action has formed a higher peak than this one right here. So I would be shifting the upward trend line to the right. And I would require a second break in order to reaffirm the sideways motion. Mind you that the RSI indicator is falling, aiming for the reading of 50, implying a rather indecisive market, which may more or less allow for the sideways motion to be maintained. But as long as the upward trend line remains here intact, that could more or less, here it is, could more or less maintain a bullish movement. Also note how all the moving averages, the 100 in orange, in green the 50, and the 20 moving average, it's the median of the Bollinger Bands, seem to point upwards, maybe with the last one actually easing a little bit and flattening out, exactly reflecting the correction lower here. It's going to be interesting to see what happens here. In every case, should the bulls maintain control, we may see the price action aiming for the 0.6725, maybe even breaching it, and start aiming for the 0.6820. On the other hand, should there be a bearish movement, a selling interest, a clear-cut selling interest, I would expect the price action to drop, break the pre-mentioned upward trend line. But for a bearish outlook, I would require the pair to also break the S1 0.6605 and start aiming for 0.6515. Okay, let's have a look at Euro USD. Zooming in a little bit. It's just below, but allows us to go a little bit lower. There's a very, very strong stabilization, very narrow range bound movement. That's better. It's as if the pair has found support at the 1.0860. I'm shifting my first support line a little bit lower. There has been no clear break, but you can see that the overall sideways motion right here tends to highlight this level. It was a level which was also tested here. So more or less that seems to be providing some support. It could go even a little bit lower, maybe to 1.0850, 1.0855. We're talking about 5 to 10 pips lower maybe. For the time being, the price action was able to breach the upward trend line, guiding it. And at this point, I would be highlighting a possible downward motion. Will be interesting to see whether that materializes or not. Should the bears maintain control and actually breach the 1.0860 floor, then the next possible stop would be the 1.0685. That's pretty wide. Could go lower. But definitely the S1 has to be breached first. To the upside, should the bulls take over, we may see it start aiming for the 1.1040. On the fundamental side, the euro is a big question mark. On the one side, we see that inflationary pressures are dropping, they are easing. And that tends to corroborate with ECB's narrative that rates are at a restrictive level and will be able to actually reverse inflationary pressures back down to the ECB's 2% target. However, I would be highlighting here that ECB President Lagarde had highlighted the possibility of inflationary pressures rising once again in the next couple of months before they start dropping once again. That's something which we should maintain in the back of our head. My main worry, though, may not be so much on inflation, but on growth. And we see that we have a Eurozone which is at best anemic in growth. And actually, the outlook, in my opinion, is pretty dark, at least for the next 6 months. We may see a contraction, maybe even a recession. Hopefully, it will be shallow, of the Eurozone. Overall, fundamentals seem to be weighing somewhat on the Euro side, yet Euro USD remains stable as the US dollar also tends to remain rather weak. So it's a battle of the weakest here between the Euro and the US dollar. Okay, let's have a look at USD JPY. Another interesting pair in the sense that there was an intense downward motion. Now, at this point, allow me to make a recalibration of the pair. A wide one, may I add. Definitely this has to be lowered. As has to be lowered. This one has to be lowered. And this one. You can see how the pair, especially if... Let's get these labels out of the picture. Let's zoom in a little bit. You can see that there was a clear-cut clear-cut resistance level right here. It was tested once, twice, 3, 4 times. We shouldn't lose an eye out. 149.75, 70 maybe. Yep. And there was a nice peak here. So that was a turning point. And that was 151.90. Okay, that remains. I would be also noting this level as a resistance level, and that would be the 148.30. Support line at 146.25. And let's go hunting. A beautiful support line right here. At 144.40, that remains intact. Let's go further back for an ultimate support line. There are some peaks here and here. However, I would go lower and mark this true here, with the next one being here. You can see how this level also provided resistance once, twice, 3 times. $142.80. Readjusting the chart. Here you go. Okay, let's start with correcting the labels. 151.90 remains unchanged. Locking it in. Next one, 149.70. 148.30. 146.25. 144.40. And finally the S3 at 142.80. Now on the fundamental side for Japanese yen, I would be noting that there has been lots and lots of rumors on whether BOJ will be practically normalizing its ultra loose monetary policy next year. It's a scenario which cannot be neglected. Some tightening of monetary policy could be expected on behalf of BOJ. On the other hand, though, we have to note here that inflationary pressures seem to be falling. At least BOJ's core CPI rate dropped last week. And we expect also another drop of Tokyo CPI rates tomorrow during the Asian session, which, due to the density of the population in Tokyo, may weigh on the CPI rates nationwide. And if that's the case, then it may be difficult for BOJ to actually proceed with the tightening, especially if we're talking about next year. So we still have the December CPI rates to be released, the November and the December CPI rates to be released before BOJ's interest rate decision, the first interest rate decision in 2024. So should there be further deceleration of the CPI rates and easing of inflationary pressures, I wouldn't say that there is not going to be any tightening, but any tightening may be very, very, I wouldn't say material, but still not so sensed by the markets. Nevertheless, a shift in BOJ stance could actually provide additional support for JPY. And definitely the market's expectations for such a shift could start strengthening JPY from earlier on. For the time being, we note on a fundamental level that a number of BOJ policymakers tended to highlight that it's premature to start talking about a rate hike in Japan or in BOJ's monetary policy. Nevertheless, on a technical level, we note how the price action is actually flirting with the lower Bollinger Band. Note how it was breached in the late American session on Friday. And actually, that was on Friday. It was today. Let's have a look. Yeah, it was at today's opening. Okay. And it actually formed once again or verified the 146.25 support line. For a bearish outlook, though, which seems to be the case here, I would expect the price action to drop below the S1 146.25. And when I'm talking about the bearish outlook, I'm basing it on 2 factors. The first factor would be that we have a downward trend line which is still guiding it. You can see how the pair is marking lower peaks, but also lower trows, and the RSI indicator is aiming for the reading of 30. On a fundamental level, at this point, USD weakness may allow USD JPY to continue rolling down. And should the bears maintain control, I would not be surprised to see USD JPY actually breaching the S146.25 and start aiming for the S244.40. On the other hand, we may see the pair stabilizing. In such a case, we may see the price action of USD JPY remaining between the R148.30 and the S146.25. Now, for the possibility of a bullish outlook, in our opinion, that's not so probable, but it's still a possibility, and it should be covered. And for bullish outlook, I would require actually 3 elements. A, I need to see the pair rising and breaching the downward trend line. That's the first. That would be a first signal that the downward motion has been interrupted. The second element I would like to have would be the price action to actually breach the R148.30. So practically, the pair has to stop creating lower peaks, lower trows. So a breach of the R1 would exactly signal that the latest peak would be higher than the previous one. So that would be an interruption of the downward motion as well. And the third element, I would like to see the R2 being tested, if not breached as well. Such a movement would allow us to actually start drawing an upward trend line showing us the limitations of the upward movement. By the way, once again, we tend to maintain the base scenario here is for a bearish outlook given the downward trend line and the RSI indicator, which is actually pretty near the reading of 30. It's at 35.6 and still dropping, even bit by bit, but still there. Okay, let's have a look at cable. Now for cable, there's a different picture in the sense that the pair seems to have stabilized, and that's being signaled by 2 elements. The first element is the fact that the upward trend line has been breached. Okay, this is not needed here. And the second element is the fact that the price action is revolving around the 1.2645 resistance line, now turned to support. Let's have a look at the ultimate resistance level, unlocking the chart. Beautiful touch verifying here the R2. Okay, this is going way, way back. Let's drill into the daily chart. That's not enough for me. That's better. This is an interesting level in the following sense that it's being tested to the upside here, and to the downside here, and here. Lots of commotion here. I think I'm keeping it. It's a bit narrow if compared to the next resistance line, but I think it's valid. So let's keep that. And that would be in red, the 1.3365, locking it in. Let's correct the labels as well. And then we get a clear picture. By the way, let's drill out to the daily chart, to the 4-hour chart once again. That's better. the R1 at 1.2815, the R1 at 1.3140, and the last one being set at 1.3365. Let's verify it once again. Yep. So we are maintaining here bias for the sideways motion to continue, and that's being practically supported by three elements. A, the fact that the price action has broken the upward trend line, which has been guiding the pair since around the 13th of November. The second element would be the fact that the price action seems to be revolving around the 1.2645 level. Note how the Bollinger Bands have now exactly highlighting this lack of volatility on behalf of the pair. And that could allow the sideways motion to be maintained by cable. And the third element would be practically the RSI indicator, which has neared the reading of 50. It's actually at 52.6, implying more or less a rather indecisive market about the pair, which could allow a sideways motion to be maintained. Now, for bullish outlook, I would require the price action of cable to breach the R1 1.2815 and start aiming for the R2 1.3140. Okay, it's not going to be reaching it. We're talking about 300 pips here. It's a wide distance, but definitely start taking aim of the R2. The bearish outlook could occur should the price action turn decisively lower, breaching the S1 1.2645. Note how the 1.2645 is a cutoff point practically, and start aiming for the 1.2325, which is way, way below it. Okay. Another interesting element here about GBP USD would be the similarity it has with Euro USD. And it tends to highlight exactly how both currencies are maintaining more or less a weak position against a weak US dollar. And that allowed for the stabilization to take place. It's not so obvious in regards to the pound, but overall, it's still a very, very similar story behind it. We expect that the revolving around the S1 is to be maintained. So be prepared to practically start maintaining more or less the level as a resistance and the support line at the same time. I would be noting here though that we could be placing another support line. Allow me to drill into the daily chart, and such a level could be set on this level, on this true here. That would be the 1.18 support line. But for the time being, once again, sideways motion back to the forward chart. There we go. That should sum it up. I think from all of us here at IronFX, best wishes for solid trading.
my name is Emily. We've already looked at margin level and margin call level in our previous videos. Today we'll be looking at stop out level. The stop out level is when the margin level falls to a specific percentage in which one or all of your open positions are closed automatically. This happens because the trading account can no longer support your open positions due to a lack of margin. Basically, the stop-out level is when the equity is lower than a specific percentage of your used margin. If this level is reached, your broker will automatically start closing out your trades, starting with the least profitable positions in order to free up margin. The stop-out level is calculated according to the specific level set by the broker, your trade size, leverage, and equity. If the stop-out level is set to 50%, this means that once your equity falls to 50% of your used margin, then a stop-out will be triggered. The easiest way to avoid unexpected stop-outs is by applying good risk management techniques. For example, you can set stop losses, limit exposure, and you can also top up your account equity to increase your margin level. Hope you found this video useful and stay tuned for more educational videos. Thank you very much. Bye-bye.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, first things first, a risk warning as per usual. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here's our agenda for today. So we're just going to get right into chart patterns, looking at the top 3 reversal chart patterns and the top 3 continuation chart patterns. And then we're going to look at how we can incorporate them into a strategy. If we have time after that, which we probably should have, we'll then do a recap of Fibonacci and market structure, because then that leads us into other types of patterns, such as your harmonic patterns and your Elliott wave patterns as well. So we're just going to add a bit of bonus for this webinar as well. So if you have any questions throughout the webinar, feel free to let me know in the chat. And yeah, let's go ahead and get right into it. Okay, so what exactly are chart patterns? So chart patterns are visual representations of historic movements in financial markets. So in your stocks, currencies, so like your forex, commodities, so on and so forth. And these patterns are used by traders and analysts to make predictions about future price movements. So the patterns are the distinct formations that's formed by the movements of security prices on a chart, and they serve as the foundation of technical analysis. So a pattern is defined by a line that connects common price points such as closing prices, highs or lows over a specific time period. So technical analysts and chartists look for patterns in order to forecast the future direction of a security's price. So these patterns can range from the simple to complex, such as double head and shoulders formations. So let's now look at the top 3 reversal chart patterns. So these chart patterns basically indicate that there will be a reversal in trend. And of course, you would know that there are a lot of different ways for you to identify a trend reversal. But these chart patterns are our top 3 ways. Of course, you should use these not on their own, but also in combination with other technical analysis methods. So like your indicators, your moving averages, MACD, so on and so forth, or even your support and resistance levels, Fibonacci. Yeah, so if you manage to get a confluence area, which means there are multiple indicators that tell you that a trend is reversing, that's a bonus, and it's more likely that what you expect would likely to happen. So firstly, we have a double top. So a double top is a chart pattern where the price reaches a high twice, as you can see from the image that I've shown here. So we have one top and two tops, and it fails to break out higher during the second attempt. So you can see that it reverses off of that same swing high resistance. So the pattern comprises of two peaks of nearly the same size and a bottom between them. So the bottom would just be this valley area over here. And then the neckline is where we measure that support level from the bottom of that valley, I mean. So the line running through the tops is the resistance line, which should be nearly horizontal. And the pattern forms an M shape and is considered a bearish reversal chart pattern. So the pullback between the two highs should be moderate. So the pullback is just over here. And the new minor support level is then called the neckline or the support level. And then the pattern is confirmed once the price breaches the low of the pullback between the two highs. So basically, once it breaks out of this neckline area or the swing low support over here. Okay, so I've also included a candlestick formation of what I'm talking about here. So you can see based off of the chart, we have two swing highs that are about the same, or rather it's about horizontal. And then we have the valley that I was talking about earlier, which forms our neckline. And then eventually when it breaks out of that neckline, which means just over here, this area here, then that's our double top formation, or rather double top confirmation. Okay. Next, let's take a look at double bottom. So a double bottom is a chart where the price holds a low 2 times and fails to break lower during the second attempt and instead continues higher. So yes, you can kind of say that this is the opposite of a double top. So the pattern is characterized by a distinct drop in price, followed by a slight reversal or bounce, with a second drop occurring soon after to either the same or similar level as the first before another. Significant reversal so that the chart appears to take on the form of the letter W. So kind of opposite of double top, we have the neckline, instead of being on the bottom, it's on the top. And then instead of having two tops, we have two bottoms. The double bottom confirmation, similarly to double top, happens once price surpasses the neckline. Okay, so the double bottom reflects very strong levels of support, as you can see here. Okay, strong levels of support often indicates a strong change of trend. So that's why you can see once we see price breaking out of here, we can then assume that price has reversed and we're expecting price to continue upwards instead of continue to hit this strong support level here. So double bottoms appear in a downtrend and reverse it to the upside as price breaks through the resistance line. So in this case, our resistance line is the neckline here. So once again, I've included a candlestick example for you to take a look at. Our double bottom has these two, I was gonna say heads, but in this case, I guess they are kind of swing lows in this case. So our swing lows also form a almost horizontal or horizontal level, and that's kind of what you're looking for over here. It's okay if it exceeds by a little bit, as you can see from our example, but it should be approximately horizontal for you to take note of it. So you can take note of the entire length of the wick and you don't have to just measure it from the body of the candlestick. And then once price breaks out of this neckline or this resistance level, then we can say that there is a double bottom confirmation. Okay, so far pretty straightforward patterns. Next, let's take a look at heads and shoulders. So this is also pretty common. And the head and shoulders is a chart pattern that's described by 3 peaks. The outside two are close in height and the middle is the highest. So it's a bearish reversal chart pattern. And this begins with an uptrend with 2 higher highs. So you can see from the example here, I have the higher highs here would be number 1 and number 3, and the 2 higher lows. So the 2 higher lows here will be 2 and 4, and these form the left shoulder and the head. So the left shoulder is here, the head is here. 0.5 over here makes a lower high, which is lower than points 3 and 1, and this forms the right shoulder. Okay, and the downward confirmation occurs when price breaks out of this point number 6 here. So we have higher lows from 2 and 4, and that's where we can draw our line across. Once price breaks out of here, then we can say that there is a confirmation that there is bearish reversal happening here. Similarly, I've included a candlestick example here. So same thing, we have, if you implement this diagram onto our real life example on our candlestick chart, 0.1 would be here, 0.3 here, and 0.5 here. So if I were to draw or to measure out a horizontal line, well, it doesn't have to be horizontal, just a line that extends out of connecting these two swing lows. Okay, so if I extend it out, once price breaks out of that line, then we have confirmation that price is going to continue lower. Pretty straightforward. Let me know if you guys have any questions, of course, but yeah, pretty straightforward so far. Next, let's take a look at the top 3 continuation chart patterns. So the previous 3 we looked at were for reversal purposes. Now we're going to see how we know if price is going to continue in its direction. So firstly, we have falling wedge. So all these chart patterns I'm going through now are pretty popular and quite easy to spot on your charts. Later on, when I go through some harmonics and Elliott wave patterns, those are a little bit harder to spot. But yeah, we'll go through those shapes and patterns later on. Okay, so next, let's go into falling wedge. So this is the pattern that I've included here. This is the pattern for you to take note of when you are spotting a falling wedge. So the entry, excuse me, we go for a target that's at least the size of the chart pattern for wedges and rectangles. So in the next slide, we have a rectangle as well. So we go for the target that is at least the size of it. So what we mean by that is if you take a look at the real life example here, okay, it might be a little bit different from this diagram that I have here. But basically what happens is you have this price moving upwards, and then you have price making lower highs. Okay, so it's making lower highs, whereas our bottom line, or rather the swing lows, if you connect the swing lows, it gives you an approximately horizontal level. Similarly to before, doesn't have to be horizontal, just approximately horizontal is fine. So that would be our stop loss. Okay, once we have this level that we have connected all of the swing highs, that is our entry level, and then we're going in for our take profit or target level would just be slightly above that. So because we're expecting price to break out of this shape, this higher resistance level here. So the upper red line, that's our resistance level, and we are expecting price to break out of it. Because there's a lot of downward pressure that's pushing on this area or this shape, so we're expecting price to break out, and that's why our take profit would be a little bit higher up. So that's why I've arranged the levels in this way for you guys to see. Okay, I hope I explained that properly, but let me know if you guys have any questions. Basically, if you draw out the shapes here, it would connect these three swing highs. If we ignore this area here, because we're expecting price to break out and hit our take profit there. So in the meantime, we'll just look at these three swing highs, connect these levels, and then on our bottom, we have our stop loss, and the stop loss is achieved by connecting the swing lows instead. So we connect the swing lows, that's our stop loss, and then we proceed with our entry. So we go in with our buy entry from this level, and then we see it shoot up to our take profit here. Okay. Okay, if we have time after the slides, we'll definitely take a look at some setups, and I'll definitely take a look at gold. But because this webinar is for chart patterns, so we'll take a look at our slides first. If we have time, then I will take a look at gold. Okay. So our next continuation pattern that we want to talk about is bullish rectangle. Similarly for bearish as well, it's about the same, just opposite areas, or rather opposite direction. So in this case, our bullish rectangle, we have three swing highs, so it doesn't have to be three. If you can see in our example with the candlesticks, it's just a consolidated area in which price is testing the upper boundary and the lower boundary, or resistance and support level. So if you connect this area here, it's pretty easy to spot. It's just about the same length of candlesticks and wicks. So our entry would be the upper boundary, and our stop loss would be the lower boundary. And then we're expecting price to break out of this consolidated area, break out of it, and hit our take profit. Okay, so that's for a bullish rectangle. If we're talking about a bearish rectangle, for example, we can expect our diagram to be the opposite. So instead of price moving upwards, we will expect price to move downwards. Same thing though, our entry level instead would be our stop loss, and our stop loss instead would be our entry, or rather our sell entry. And then once we're expecting price to break out of the consolidated area downwards towards our take profit, which would be, of course, lower than our entry level. Okay, so obviously for bullish rectangle, we're going in for a buy, and for our bearish rectangle, we'll be going in for a sell entry. Okay. Next, let's take a look at bullish pennants. So for bullish pennants, some people call this flag shape as well. So yeah, it's entirely up to you what you want to call it, but it's all about the same. So For a bullish flag, we have this shape here. Once again, from all of these shapes, we are basically connecting the swing highs with the other swing highs to form a line, and then we see where those lines connect. Oop, sorry about that. So we connect the lines here, and then we connect the bottom lines as well, and then it should give you this flag kind of shape. Okay, so if we're talking about a bullish flag, price will be moving upwards, and then we will expect price. So price is testing within this consolidated triangle area. So we're expecting price to break out of this area and continue in the upward movement. That's why we call it a continuation chart pattern. So price trend is upwards, price is consolidating in this area, and then if we draw out the connect the areas, connect the tops and the bottoms, then we have this flag shape, and then the next step would be to measure out your take profit. Okay, so your take profit would be, as we mentioned earlier, either the size of the same size of your shape, or bigger. So as you can see here, our shape is, yeah, you can see the size of our shape here. So our take profit would be times 2 of that. So we would measure our take profit over here. Or rather, we would put our take profit over here. Okay, so for a bearish pennant, on the other hand, same thing, just the opposite. Price will be moving downwards. Okay, instead of our buy entry being over here, we will replace it with our stop loss. And then stop loss, we'll replace it with our sell entry. Price will once again consolidate within this area, okay, or within this triangle. Once it's consolidated, we will place our take profit times 2 below that. Okay, and then it'll break out of it and then hit our take profit, hopefully. Okay, but that's just how you use this bearish pennant or bearish flag shape. Okay, so that's actually kind of it for the top 3 chart patterns for continuation and reversal. But I wanted to talk a bit about harmonics and Elliott waves as well. Just briefly touch on it if you missed our previous week's webinars. Okay, because when we're talking about chart patterns, even trend lines, support and resistance, all of that are considered chart patterns as well. So yeah, let's just talk a bit about Elliott wave and harmonics. So before I do that, in order to really understand the harmonics and Elliott wave patterns that we're going to be getting into, I'm just going to do a really quick recap on our Fibonacci, because without Fibonacci, the Elliott wave and harmonic patterns really don't quite make sense. Okay, so we have the different Fibonacci levels here, and if you've been with us for our previous Fibonacci series, we go through in depth the Fibonacci retracement, expansion and extension, as well as projection levels. But for now, I'm just going to briefly go through the retracement levels. So for the negative Fibonacci levels, minus 27.2 and minus 61.8, those are our Fibonacci expansion levels. And then the between 0 to 100 levels, those are considered Fibonacci retracement. And then for the 127.2 and 161.8, or above 100%, those are what we call our Fibonacci extensions. Okay, this GIF here, you can see we are following exactly the pattern, or rather the structure of the market, and that's quite important. So here we show you exactly how to draw your Fibonacci. So for retracement, as you can see from the previous slide, the GIF just follows exactly the shape of the chart. Pretty straightforward. My projection is not showing. I'm not sure why, but I'll show you guys that in a second. Next, if we look at expansions, we're looking for a flash kind of shape. You can see now in this GIF, I'm drawing out exactly this flash shape. Flash or lightning bolt shape, whichever you prefer. So our starting point and ending point for expansions lines up nicely with the head of the lightning bolt. And then for expansions, as I mentioned earlier, we are looking at the negatives. So minus 27 and minus 61.8, if I'm not wrong. So yeah, so we take notes of those levels, and for point 3, it has to retrace at least 50% of your starting and ending points. If we look at our extensions, you can see we've drawn out this Nike tick kind of shape. And that's exactly what we call Fibonacci extensions, the Nike tick formation, because that's what you're looking for. In this case, we have an upright Nike tick, but in the next couple of slides, I'll show you guys examples of inverted Nike ticks and how you can use those as well. For extensions, we are using more than 100% levels, so the 127 and 161.8. Okay, here you can see all the different Fibonacci numbers that we mentioned in our previous slide and how it looks drawn out. So yeah, I think you guys can see for yourselves. Positive Fibonacci retracements are our expansions. Fibonacci retracements are 0 to 100%. Negative Fibonacci levels are what we call our expansions. So more than 100% extensions, less than 0% or negative would be expansion. Okay, so here's an example. I have my Fibonacci retracement. So remember, I mentioned how important it is for us to follow the market structure. So that's exactly what I did here. My starting point here, ending point here, and I'm looking at where price has retraced this level. So this 23.6, 38.2, 50%, these are no longer valid because price has already passed these levels. Okay, instead, I'm taking note of the 61.8 because price has reversed or retraced this level and has reversed off of it. Okay. Okay, here is another example of Fibonacci retracement. Okay, in this case, I'm doing it upside down here. So, oh, am I? No, okay, this is not upside down, sorry. So my starting point here, ending point here. Now I'm seeing once again where my price has retraced to, and I can see my price retraced to the 38.2 level. So I highlighted this level because this dotted line at 32544, it is at this this retracement level, but you can see that price also pulls back all the way to this level here, this swing high. So this is what we call an overlap support. So an overlap support is basically when a swing high lines up with a swing low, and it's important because we can see that price, the bulls as well as the bears both respect this area. So that's why it's important, and that's why I've highlighted it here. Okay, so having an overlap support also line up nicely with a Fibonacci level. That's what we call a confluence area. And so we can probably expect price to reverse off of the area as we can see here. So if you have this and then you couple that with your indicators as well as some of the chart patterns that we've mentioned earlier, then you can see there's a higher chance that your analysis will be correct. Okay, so in this example, we have two Fibonacci retracements. So notice how the big Fibonacci retracement trend line price reverses of the 61.8% Fibonacci retracement level. Okay, so my Fibonacci retracement that I was talking about is here. We have the bigger one and the smaller one here. Okay, so both 61.8, but for the bigger one, my 61.8 lines up with the swing high. Okay, and then my smaller Fibonacci retracement, 61.8 as well, lines up with two swing lows. So this once again is an important level because we see that price has respected this level twice. So it's likely to respect this area again in the future. Okay. Okay, next we're going to get into Fibonacci expansions. So an example of expansion and how it plays out, as I mentioned earlier, expansions, we are looking for a flash shape. So this flash symbol also is applicable for Fibonacci projections. So our starting point is here, ending point here for expansions, and we're taking note of the negatives over here. So firstly, my first point, starting point there, ending point there. Number 3, if you can see here, price retraces up to the 61.8% level. So that is our Fibonacci retracement since it's between 0 to 100%. Yeah, so levels, it respects this 61.8, reverses off of it, and it's heading downwards. And in order for us to project where price is heading towards, that's where our negatives come in. We're expecting price to come down to this negative 27.2, where it could bounce off from support. Okay, and you can see this is the aftermath of that, and that's exactly what happened. Price bounced off and reversed off of our negative 27.2. Okay, bounced off really nicely. And a pro tip is that price usually comes back to this ending point over here. Okay, why does it usually come back? Because as I mentioned earlier, when we have if I were to extend this level, you can see price has tested this level before as well. So we already have two swing lows that line up on the same support level. Now that price has broken out of it, we can expect price to pull back to that level. Okay. Next, we're going to get into Fibonacci extensions. So we are moving a little bit fast because I want to get into the chart patterns for the harmonics and Elliott wave patterns since this webinar focuses on chart patterns. So I want to quickly get through the Fibonacci recap so that we can get into the patterns. But if you're confused, let me know in the chat. Yeah, but normally we go into that in depth each of these Fibonacci techniques in our Fibonacci series. So you can stay tuned for those, or you can go onto YouTube and take a look at those as well. Okay, so next we're talking about Fibonacci extensions. So as I mentioned earlier, Fibonacci extensions, we're looking for Nike ticks. Okay, so our starting point is the head. Starting and ending point is the head of the tick. And then once price, we're looking at this V shape. Okay, so we're looking for V shape, and the tail of the tick should exceed 100% of the head. Basically, it should be longer than the head. That's what makes a tick, right? So the projected level is either the 127 or 161.8. In this case, price has already broken out of the 127, so we are expecting price to hit towards our projected level of 161.8. And you can see that's exactly what happened here, and a reversal occurred, reversed off of this level and headed back downwards. So it's another indication of a reversal. Once again, you use this in combination with your chart patterns, like the top 3 chart patterns I went through previously, your indicators, and you're good to go. Okay, here is a GIF to show you guys exactly what kind of shape you should be looking for when you are making use of Fibonacci extensions. Okay, so we're looking for reactions off of the 127.2 and 161.8. Once price breaks out of the 127, then you can go ahead and assume that price is going to break reverse off of the 161.8. Okay, yeah, I just let you guys watch the GIF a couple of times and then we can move on. Okay, so we're watching the reaction of the 161.8. Okay, let's move on. So next we have the Fibonacci projection. And excuse me. So we have the Fibonacci projection, and this tool on MT4 is actually the Fibonacci extension tool. Okay, so ultimately, unlike the other three methods that we've gone through so far, this method actually requires 3 points. So we need the starting, the middle, and the ending point. Okay, so for this technique, we use namely three percentages: 61.8, 78.6, and 100%. But if you're using Elliott wave, we also make use of the 161.8. Okay, for Fibonacci projection, similarly to Fibonacci expansion, we are also looking for the flash zigzag kind of shape or lightning bolt shape, as you can see from this GIF here. Okay, so our starting point here, middle point here, ending point here, we're projecting where price will react off of. And we can see price has already broken out of the 61.8, 78.6, and that's why we can assume that price will reverse off of the 100%. Okay, let's just watch the GIF. Okay, so not included here is the 61.8, 78.6, but we're watching it play off of the 100%. Okay, and you can see it reached 100% before reversing off of it. Okay, but something I wanted to mention is that you can see that the wick of the candlestick was just nice touched our 100% level, which is why it's important that you take note of your trade management strategies as well. You want to make sure that you remember not to put your take profit exactly at your Fibonacci levels or exactly at your confluence areas when you're using indicators, so on and so forth. And that's because price might be, it's attracted to these levels, but it's also likely to reverse off of them because of the huge confluence area. So something that we recommend normally is to place your take profit before the level or before a confluence area, basically before where you expect price to hit. And then for your stop loss, you want to make sure that you place it beyond it. So in this case, we would place our take profit higher up, above our 100%, just in case price misses it by a little bit. At least we would have caught that this reversal. Okay? Okay, let's move on. So here's another example. I'm not sure why all of my titles are covered, but here's an example of the Fibonacci projections. So you can see clearly the starting, middle, and ending points here. And these follow the swing highs and the swing lows of price. So it's important for your Fibonacci trend line to follow price movement or market structure really closely. So price has also bounced off of the 100% Fibonacci level over here. So you can see this is our shape, our flash shape, and we're expecting price to go down towards our 100%. You can see it reversed off nicely. Okay, another example. We have a very obvious zigzag or lightning bolt shape over here. So you want to take note of the Fibonacci trend line following the market structure closely. And also we have the 78.6% Fibonacci extension. So because our expansion and our projection use the same shape, more often than not, you can use both together and find confluence areas. Okay, so you can see price really bounced off of our 78.6. One more example for you guys. Starting point, middle point, ending point. You can see the shape here. 100%, we're expecting price to hit it. And you can see it reversed off of it nicely. So an invalid Fibonacci retracement occurs when price makes a lower low. Okay, so if there are bars on the right that break your ending point, it becomes invalid. So I'll show you guys what I mean. So this is what we mean. Bars on the right that break out of this lowest point. So because this is no longer the lowest point, it cannot be your ending point. Okay, so we always want to remember to pick the lowest point with nothing on the right of your ending point. So just, this is a bad example to use for a Fibonacci retracement, basically, because price has already broken out of it. Okay? Yeah. So as I mentioned earlier, market structure is really important. You want to make sure that your swing highs and lows are significant levels so that they're good points to use for Fibonacci. And yeah, this is the kind of structure that you want to look for when you are looking for Fibonacci levels, or even when you are doing your analysis, your technical analysis. Okay, I'm just gonna skip through those and get right into pattern identification. Okay, so we mentioned earlier a couple of M's and W's, but we have a couple more patterns just briefly to go through with you guys. So for these lean more towards the harmonics patterns because they're more complex and a little bit more technical to understand compared to the top three patterns that we went through earlier for continuation or for reversal. So you can see instead of our simple M, we also have extended M's, short formed M's, instead of the simple W, as we mentioned earlier, which would be our reversal patterns. We now have extended W's and short form W's as well. So they're just slightly more complex to understand, but once you do, they can be spotted really easily as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. So similar to what we talked about earlier, we have points 1, 2, 3, 4, 5, and 6. Here we have X, A, B, C, and D. So price swings between these points are interrelated and have harmonic ratios based on Fibonacci, which is why we went through Fibonacci really quickly earlier on. So this is because Fibonacci ratios help traders in defining precise turning points in these patterns. So it tells you exactly where you can expect these swing highs or swing lows or the neckline points that we mentioned earlier that can be used as your entry and exit points. Okay. So we went through a couple of M&Ws earlier, so I'm just gonna move on to show you guys how to identify some patterns. So here are some variations of our M and W points. The breakout points, as we mentioned earlier, happen once price has broken out of the neckline area. So even though it's slightly different, uses a little bit more Fibonacci tools, but ultimately the theory behind it is about the same, or how you use it is about the same. So breakout or upside confirmation basically occurs when price breaks out of this neckline area. If we're talking about a M top, breakout or downward confirmation happens when price breaks out of this neckline. So pretty similar to what we talked about earlier. Okay, so let's talk a little bit about harmonic patterns. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their key nodes. So in this case, we have X, A, B, C, and D, as I mentioned earlier. So I've included the Fibonacci levels as well, just for your reference. So from point A to C, it uses 38.2 to 88.6. X and B, 61.8, X and D, 78.6, and B to D uses more than 100% levels. But that's just for your reference. 5-point harmonic patterns have a critical origin at X, followed by an impulse wave, which is XA. So just the blue line here. So these are followed by a corrective pattern wave to form the EYE of the pattern. So this is at B, okay, completing the AB leg. Then followed by a trend wave at BC, which is another blue line here. Then ignore this line, and finally completed at the corrective leg, CD, and we call this the potential reversal zone. Okay, we call it that because we're expecting price to break out of this neckline area in order to give us downside confirmation. So it's, even though it looks a little bit more complicated, it's basically about the same as we talked about earlier. Okay, here is how we use Fibonacci in this case. Possible pattern formation is identified after the first 3 legs. So XA, AB, and BC. Then we see where exactly we can place our entry level. Normally your entry level would come after this neckline area here, because that's where you get downside confirmation. Okay, the Fibonacci ratio extensions, retracements, and projections are then used to determine the potential reversal zones. All harmonic patterns have a clearly predefined potential reversal zone, and the initiation of new trades should take place in this zone, so over here, and only after price reversal action. So after price breaks out of this B, this B level here. Okay, so a couple of patterns for you to take note of. We have the Gartley pattern. So this is the best known harmonic pattern. So after the wave, impulse wave at XA, the corrective wave, or the corrective leg, sorry, should end at 61.8. Okay, 61.8 retracement of XA. Point C falls anywhere between the 38.2 or 88.6 retracement of the corrective leg of AB, including all harmonic trading ratios that fall between these two constraints. So it can be 50, 61.8, 70.7, 70.6, basically any level, Fibonacci level that's between these two numbers. Okay? And yeah. Long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So if we're looking at bullish, your potential reversal zone would happen obviously after this this neckline level here. So your potential reversal zone would happen somewhere here. If we're looking at a sell, it would happen after it breaks past the B level. So anywhere after that. Okay. Next, let's take a look at bat pattern. So this is considered the most accurate pattern. And you can see once again it's pretty similar to your W and M patterns. Okay, just with a couple more Fibonacci levels to take note of. So some main rules of the pattern: AB leg can retrace between 38.2 to 50% of the XA leg. The BC leg can retrace between 38.2 to 88.6% of the AB leg. And the CD leg can retrace up to 88.6% of the XA leg. CD leg, so the last leg, can also be an extension of between 161.8 to 261.8 of the AB leg. Okay, it doesn't make sense now that you are just looking at the shape. It just looks like a bunch of numbers, but when you actually try using Fibonacci levels to distinguish the different patterns, it would make more sense then. Okay, and then for the bullish, of course, it's just the opposite of your bearish. So here's an example of a cipher pattern. So cipher pattern uses 38.2% to 61.8 for XB, 127.2 to 141.4. This is for your AC, and for XD, 78.6. And bearish is the opposite of that. Okay, so here is what a cipher pattern looks like on the chart. So you can see it's a little bit more difficult to identify because you would need to take note of the numbers, but ultimately it's still the theory behind it is still the same. Because after it breaks out of this cipher pattern, then we are expecting it to move upwards after it breaks out of this B shape here, or rather this neckline. Once it breaks out of it, that's our potential reversal zone, right? Then it's going upwards, and we can place our take profit, as we mentioned earlier, 2 times the size of your B. So from here to here, this is your potential reversal zone. So times 2 of that will be here. Okay, remember we want to place our take profit before any important levels. So we probably place it somewhere lower just to be safe, just to make sure that we catch that before the reversal occurs. Okay, butterfly patterns. So butterfly pattern requires a retracement of the impulse leg XA by 78.6. Okay, you can take a look here. So I'm just going through the different types of patterns, but there are a lot of different types of patterns. You could probably Google it. But yeah, I'm just going through the different kinds of chart patterns that you can see. Okay, but I think the most important ones are the ones that I talked about at the start. These are just more for your knowledge. Okay, so point C retraces anywhere between 38.2 to 88.6, as you can see here, of the corrective leg AB. Okay, bullish would just be the opposite of that. Crab patterns. So the crab pattern was discussed and released in 2001. So this is an extreme pattern, and the corrective wave AB should end between 38.2 and 61.8 retracement for the impulse leg of XA. Okay, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So stop loss would probably be somewhere here. Okay, remember the potential reversal zone is basically the area after the neckline area. Okay, bullish sharp pattern. After the impulse wave XA, the corrective leg should end between 38.2 and 61.8% retracement of the impulse leg XA here. Okay. So you can see the arrows. Once price breaks out of this level here, then we're expecting it to reverse. Similarly over here, we're expecting it to reverse. Okay, just some advantages and disadvantages for you to take note of. So they are repeatable, reliable, and do produce high probable setups. And they provide future price projections and stop loss levels as well. And they can be considered as leading indicators. Their trading rules are relatively standardized since we're using Fibonacci ratios. So, and they work on all time frames as well. Okay, some disadvantages are that they are quite complex and technical to understand and master. But like I mentioned earlier, as long as you have the basics or you kind of know what you're looking for, once you master the art of Fibonacci, then you've kind of got it under your belt. Okay. And yeah, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful. And yeah, I will see you guys next week. Thank you guys so much for coming. Have a great rest of your week. Bye, everyone. Thanks, guys. Bye.